not only as an employee do you earn a regular salary, but you also get paid in fringe benefits. All right, a company may pay a big portion of your medical. You might have a paid vacation amount. You may have retirement benefits. Okay, so when you're working, you're not usually just getting paid a salary. Oftentimes, you're also getting these fringe benefits as well. Well, I don't know how many of you have ever worked for a job in which your vacation time accrues the longer you work there. So if you work there for 1 month and you have 12 days of vacation time allotted to you during the year, then after 1 month you earn 1 day vacation, and after working there 2 months you earn 2 days of vacation, and so on and so forth. Okay, well, as this is going, so basically what's happening is as you work, you earn that vacation time. So let me pop ahead 2 slides here. As you work, you earn vacation time. So when you have that happening, what's going on here is what you're doing is you're almost accruing your vacation time, or the company is accruing that expense, and they're setting up a liability account to pay that out to the person when they do take the vacation. So all year long, in this case they did it once at the end of the year, December 31st, but really a company could do it monthly or by pay period, however often they really want to. But let's just say that, they're accumulating, people worked all year and they know that they're going to have to pay out about $325,000 in vacation pay. So what that's going to look like is this journal entry: debit to vacation pay expense and a credit to vacation pay payable of $325,000. Okay, so what they've done is they've recorded the expense because it is an expense of the period. The people earned it during this year, and they're setting up a liability to pay it out when the people start using the vacation pay. Alright, what that's going to look like, I don't think I have another slide for it. No, I don't. What that's going to look like when you actually pay it out is going to be a debit to vacation pay payable as you start using up that, taking away from that liability and paying out their vacation pay. So you have a debit to vacation pay payable and a credit to cash. There's actually more to it than just cash, but we'll keep it simple and we'll say it's a credit to cash for the amount of money that's going to be paid out to a particular person when they use up their vacation time. Alright, let's talk about pensions for a second. There's 2 types of pensions. There is a defined benefit pension plan and a defined contribution benefit plan. What a pension is it's money basically you have for after you retire to live on, okay? And you should be putting away as much as you can, as early as you can. Alright, let's start talking about first the defined contribution plan, which more of you are going to see than not. Alright, a defined contribution plan is similar to your 401k. In the sense of that the company is defining its contribution to you. How 401k works is usually maybe they say that if you put away, me, the employee, if you put away $1, then the company will match that dollar for 50 cents. So for every dollar I put away, a company puts away 50 cents. So if I put away $1,000, the company will put away $500 towards my retirement for my behalf. Now it is entirely up to me to make sure that I manage that money properly, because what's happening is I'm putting in $1,000, a company's putting in $500, and what they have chosen is they've chosen a trustee of this money, of these funds. So you might have a big management company like a Fidelity or a T. Rowe Price or something like that, and what they're doing is they run retirement plans. So you were usually given, as an employee, you were usually given an option of 10, 15, 20 funds that you can choose to invest that $1,500 in, and you make those decisions yourself. Alright, usually they'll offer some guidance to you, but for the most part you're making that decision yourself. It is up to you entirely to make sure that you are putting away enough money for your own retirement. Okay, the company has defined its contribution to you. They have told you what they are going to contribute on your behalf. Alright, that's different than a defined benefit plan. Alright, so here let's look at a journal entry for defined contribution plan. Alright, so a pension plan of Heaven Sent Perfumes requires an employee contribution of 10% employee monthly salaries, to employee 401k plan. Basically, we know that $50,000 has to go away. Alright, we know that they are going to contribute $50,000 on the employee's behalf. So as far as a journal entry goes, it's just simply a debit to pension expense and a credit to cash. The company has an expense of pensions that they're paying out to their employees, which is a cost of doing business, and a credit to cash for that $50,000. And once it leaves the company's hands, they really don't touch it again. They give the money to that trustee, to that T. Rowe Price or that Fidelity or Vanguard, or any number of other ones. and they manage the money from that point. So once, the company can't reach back out and say, hey, I need that money back. It doesn't work that way. Okay, the other type of plan is a defined benefit pension plan. And what a defined benefit pension plan does is it defines what the benefit is going to be. What I mean by that is the company is going to say, after you retire, we're going to do this calculation and you're going to earn this much money every year. We're going to pay you, let's just say, $40,000 a year for the rest of your life. So what they're doing is they're defining the benefit that they plan to give to you once you retire. Now in this scenario, you as an employee puts away nothing, basically. The company puts away all this money on your behalf. The onus is on the company now to put away enough money in this pension plan that by the time you retire, that money is sitting there for you, ready to start getting paid out to you every year from that point forward. Now, the only people who typically have this type of plan are going to be teachers, but not even newer teachers. I mean, even for me, who is a full-time teacher, I'm in a defined contribution plan because defined benefit plans have kind of gone the way of the past. They're difficult to manage. It's hard to calculate how much money people are going to, how much money to put away for people for the next, after they retire. If somebody retires at 65, then I have to do, as the employer, I would have to do a calculation saying, how much longer do I think they're going to live? And, how much am I going to pay them a year? And how much do I need to put away in order so that they get that amount of money every year? There's a lot of work on the behalf of the employer in a defined benefit plan. All right. So with that, these are kind of, like I said, have kind of gone the way of the past. Older teacher plans do have these defined benefit plans. Your police have defined benefit plans. Paid firemen, they have these types of plans. But you're not going to see them in a regular course of business anymore. In addition to pensions, you might also get some additional post-retirement benefits. You might get free medical care for the rest of your life. You might get dental care for the rest of your life. All right, now I'm just going to use my mother as an example, who was a high school teacher for 30 years. And she not only has a defined benefit pension plan and gets paid a certain amount every year, she also has medical care for the rest of her life and dental and vision as well. Okay, so that's something that you would get even beyond the pension. Now, if you think about why this might be, if you think about way back when people would have jobs and they would have the job, they would get a job and they would keep that job and they would work at that particular company for 40 years. So until they retired. So the company felt like they almost had a responsibility to those employees. They felt like they needed to provide for them in their retirement since they had worked so hard for them their whole lives. And that's where the defined benefit plan came from. Now what happens now? How many people really work for one company for all their lives? Usually you job hop from company to company many times throughout your career. All right, so with that, you can take those 401ks with you from job to job to job and not have to worry about this, what am I going to do with the pension I've got with this company? All right, your 401k follows you from year to year. All right, so let's talk a little bit about contingent liabilities. If you think you're going to have a liability arise from some sort of a past transaction, then you need to record it. And you need to record this. A contingent liability is a potential liability that could happen. And the way you kind of assess the criteria as to whether or not you need to record a liability is whether or not the liability is probable. That means likely. Is it likely to happen? And can I estimate the amount that the liability will be? If those two cases are true, then I have a responsibility for recording that liability in my financial statements. Okay, so like I said, probable, if there's the probable and there is the estimable aspect of it. So one thing that is typically a journal entry that you would be a contingent liability would be for a warranty. Okay, if we were selling something like refrigerators or microwaves or something like that, chances are good something's going to go wrong with a bunch of them. That's just the way it is. So with that, it is probable that I'm going to have these liabilities from the products I'm selling, from the refrigerators that I'm selling. Additionally, I can usually figure out how much that liability is going to be, in the sense of, I've been doing business for 10 years, and typically 5%, using the number that we're going to talk about in this problem for a second, 5% of those people come back to me with repairs. All right, so here's the scenario. During June, a company sells a product for $60,000, which there's a 36-month warranty. Past experience indicates the average of cost to repair defects is 5% of the sales price. Okay, guess what? We don't care how long the warranty is. The recording of a contingent liability, especially in a warranty example, is as soon as you make the sale. Alright, as soon as you record the sale, you record the liability. Even though it hasn't happened yet, you're going to record the liability. So 5% is $60,000 is $3,000, so we set it up as a product warranty expense and product warranty payable. We're setting ourselves up, we're setting the liability to pay in the future. Alright, when a customer finally does say, hey, guess what, my refrigerator broke, I'm going to debit the product warranty payable for that $200, which is the case here, and I'm going to credit to supplies, right? You know, whatever part I needed to fix that refrigerator, I'm going to record it here as a credit. Alright, so that's an example of contingent liability. And here's a nice little chart. The idea is if it's probable and estimable, I have to record the liability. If it's anything other than that, well, alright, here's the other case. If it's remote, like there's no chance of it happening, I'm not going to do anything. Like if somebody sues me for some absurd reason, I'm not going to record anything. But if it's possible, or I can't estimate the amount, I need to put a note in the footnotes to my financial statement saying, hey, we think there's going to be a liability, but we can't estimate it. Or we think there's a liability, but it's possible it's going to happen. The idea is probable and estimable, I need to record the liability with a journal entry. If it's remote, I do nothing. Every other scenario, I need to record a note in the financial statements. Alright, and that's pretty much it for this chapter. Have a great day.